Welcome to the latest in our series of monthly market updates. In recent weeks, markets have seen uncertainty creep back in. This came after a period of positive performance that started in the second half of June. August, on the other hand, closed with markets down, with portfolios losing some of those gains over the first half of the month. The trigger for this was Jackson Hole, the annual symposium of central bankers, policymakers, academics, and economists in Wyoming. The event has become an important platform for understanding the point of view and position of the Fed. Chairman Jerome Powell's speech was equally weighted this year. Will the approach be dovish or hawkish? Cautious or aggressive? The message came through loud and clear. The Fed intends to continue down the path of rising rates, keeping them high for as long as it takes, and accepting that the economy will weaken as a result. Powell was clear that the central bank's key priorities remain inflation control, even if it comes at the cost of triggering recession in the economy. Monetary policy expectations have changed accordingly. An interest rate cut in 2023, in the face of an economic slowdown, is no longer the most likely scenario for investors. In the short term, markets reacted badly, perhaps expecting a more accommodative stance from the Fed. This reaction negated some of the gains they'd made over the past couple of months. This all serves to remind us there's a delicate balance between monetary policy, growth, and inflation. With prices rising, central banks find themselves forced to raise rates, which risk further damage to an economic situation which is already showing signs of slowing down. The goal is to achieve a soft landing. That is, getting inflation under control without necessarily triggering a recession. We still see this as a possible outcome in the US, and one that would naturally be positive for portfolios. In the States, economic data is solid, and inflation is showing signs of slowing. Unfortunately, the same cannot be said for Europe, where the ECB finds itself in a more precarious economic situation that has been exacerbated by the energy crisis. The European Central Bank is behind in terms of interest rate hikes, with the economy slowing at a faster rate and inflation spiking. Because the price rises are caused primarily by external factors, like rising commodity prices, monetary policy will be less able to make a direct impact here. This goes some way to explaining why European equities have performed worse than those in the United States. You might remember that we reduced the relative weight in Europe in our portfolios at the beginning of 2022, a position we intend to maintain for the moment. Against this backdrop, we're happy to maintain our conservative position, despite some favourable valuations. We're considering adjusting the geographic position of our equity investments, with energy uncertainty pushing us further away from European equities. We're also looking at inflation expectations that are embedded into some market prices. For the Eurozone, we see forecasts collapse from 9% to 2.5% in 1 year. This could open up some interesting possibilities on the bond side. Thanks for watching. We'll be back with another update next month. If you have any questions or want to discuss the situation in more detail, please don't hesitate to get in touch.